territories? Great, Tim, glad you remembered. That they are now out there in all 50 states, all right, and all the U.S. territories and the like. Right? They have a maximum loan amount under this one, which is an economic injury disaster loan caused by coronavirus, of $2 million maximum loan, interest rate of 3.75%, and the term can go as long as 30 years. One of the most intriguing opportunities that exist under an EIDL loan, and why we were urging so many of you to get in line to begin processing these loans as early as possible, and of course the last 10 days or so of our engagement with you, was because, right, under an EIDL loan, you can get a $10,000 advance as emergency capital. That was true, we thought, through last Friday, when coincidentally the CARES Act was passed. But on Friday, the SBA sent out this announcement. We're updating our system to implement this provision, and so anybody that wants to can request an EIDL advance when they apply for the loan. This update will be forthcoming in the days ahead of us. In the interim, you can still apply for the full EIDL, but you'll need to reapply for the advance when the system is updated with streamlined application. Well, kind of defeated our purpose of getting in line to begin with. Many of you today received a notice from the SBA that you may have interpreted to say that you needed to start your EIDL application all over again. That is not what it meant to say. It meant to say, oh, wait a minute, you're not going to get the emergency advance unless you come back in and reapply for it. Now, unless you are in desperate need of cash because of coronavirus already, that may not be the best thing for you to do at this point in time. On Friday, right, so the critical reason is this, okay? In most cases, if you do go through and receive an EIDL loan, not necessarily the emergency grant, you're not going to be eligible for the loan program that is now there under 7A. 7A is one of the two other loan programs the SBA runs. It's been around forever. It is run by banks. The loans are made by banks. The SBA guarantees a high percentage of the loans, up to 85% under 7A, historically. And they can be used under that program for working capital or to acquire another business. There's a third program that some of you may have, and that's an SBA 504 loan, much lower portion of guarantee, typically 50% from the federal government. And it's used to purchase buildings for your commercial operations. Our concern now is that if we pursue our EIDL loans, most of us are not going to be eligible for the PPP loan. And so we started, all right, during the course of this week, once we had seen the provisions, which again, all right, were only available to us late Friday afternoon, I prepared this slide saying, you know what, we should withdraw any EIDL applications at this point. We're probably not going to need or get an EIDL loan in excess of our PPP loan, our 7A loan, and we might, all right, jeopardize the 7A loan. Kim correctly, all right, made me think about it a bit, brought us back to the point, says, you know, let's just let the EIDL applications sit what they are. Don't pursue them actively, but don't let them go to bed either. There's a possibility that for some of you, I talked to a member yesterday afternoon whose business is down close to 70%, may be eligible for both. So, what we really want to talk about today is CARES, C-A-R-E-S Act, and the Paycheck Protection Program that has become available under that program as of last Friday afternoon. It is a remarkable loan program, one of the most significant, extraordinary that I have seen in my 55 years of business. It's got a lot of things that are extremely beneficial to us. So what's it about? Well, on Friday, all right, with full consensus of both the House and the Senate, $349 billion were set aside to help small business through this pandemic issue that we have. And they're going to do it by attempting to give us loans that will keep our employees on the payroll while this condition continues. And they're going to give us loans where the vast majority of that loan may be forgiven, provided that we do keep those employees employed. So we're going to go through everything we know about it here today, how you should deal with it, what you should be prepared to do, and where you should go to process it. It is a traditional SBA loan. It is not a loan coming from the direct SBA. The fact that you filed an EDIL application will not make you eligible for this loan, nor will it be something that can be transferred to your 7A bank. It's going to be a separate loan application apart from the EIDL application, and it's the one that we perceive is going to be best for you to pursue now that we know the contents of the bill. So first of all, who of you is eligible? And the answer is every single company on this call, I am certain. All you need to be eligible is to be less than 500 employees and to have been in business on February 15th of 2020. You need to provide a good faith certification, not that you have been damaged to date by the coronavirus, but that the economic uncertainty caused by CV1 makes your loan request necessary to support your ongoing operations. Personally, I believe that every company can do that here without even looking up. I believe if you are in a portion of the United States where the treacherous infection rate of coronavirus has already escalated to massive situations, such as New York City, you would know that your loan request could be necessary to support your ongoing operations. I just had a member call me from the Southeast saying his state is making a containment declaration, but that his business, his type of business, our business, appears to be characterized as non-essential within his state. Certainly, that economic uncertainty is going to drive him to the point where he couldn't possibly support his operations, with revenue likely to drop 50, 60, 70% without a support loan. So this is the primary affidavit you need to put here. We believe that, all right, this loan is going to be necessary to support our ongoing operations. And then you must use the loan proceeds for the purpose that was there. And basically, the core portion of that purpose is to keep people employed, keep people working through this situation in a manner where they can be supported by you, current employer, and not, all right, be simply on unemployment and those types of remedies. You're going to be able to use whatever amount you are eligible to borrow under this loan to maintain that payroll, to pay any mortgage payments on any buildings associated with your business, and or right to pay the rent associated with those buildings, and to pay any utility costs, including your telephony costs, your internet costs, things of that nature, from the proceeds of the loan. The only other hooker is that you are not receiving or assistance that would duplicate this purposes under any other SBA program, such as the EIDL. That's why we're a little bit concerned about the relationship between the two. For the time being, maintain your application. I would not pursue it unless you are in need of the emergency grant, and actively pursue the PPP loan, which probably will be in place of an economic injury disaster loan, except in very unusual circumstances. So what are the terms of this loan going to be? They're going to be different than right? VIDL. The maximum term here is 10 years. And the interest rate may be as high as 4%. You're not going to have to make any payments on the loan until at least 6 months from the date it originates. So if your loan is approved on April 1st, 6 months later, to your first payment. During that period of time, the 4% interest will accrue on any amounts not forgiven, but the deferment may be as long as 12 months. So how much can you borrow? Well, for most of us, except for those of you that have 60, 70, 80 employees, we're going to be able to borrow 2.5 months worth of our monthly cost. Even at 67, 80 employees, we'll still be able to borrow. We're just not going to be in a fast track. The maximum loan is $10 million, and I know there's not a company associated with TAG where 2.5 months of their payroll would approximate $10 million. So that's our maximum loan amount, right? And what it is about, it is associated with, right, 2.5 months of our payroll cost. What in the dickens does payroll cost actually mean under this loan? We are very, very clear on this point. Oh, one quick caveat, right? Some of you, we have a few TAG members who lease their employees. And are those leased employees, is their compensation going to be part of the PP loan equation relative to payroll costs? We do not know the answer to that now. This is one of the areas we are seeking guidance from as many sources as we possibly can. We hope to know the answer within the week. Please go ahead and apply for your 7A loan, even if get in line, even if this is your situation. There's great reason for these employees to be included. And the reason for that goes back to the eligibility under the loan. Small companies, 500 employees or less, fit under this particular loan umbrella. It is designed to deal with the guys that work for you, even though they are leased. However, the company that actually employs them, because they are an employment company, is highly likely to have way more than 500 employees, which means that there would be no incentive for you as the owner of this business to try and maximize your employment, the whole purpose of the bill, if you cannot, right, be able to borrow against it and or, number two, right, get the proceeds forgiven as your other peers would be able to do. So what's included in payroll cost that we are certain of? Well, first of all, it is the salaries, it is the wages, it is the commissions of everybody that works for you, including all commissions for salespersons and things of that nature. It is all of their PTO days. It is all of the parental, the family, the medical or sick leave that you might have paid them or paid for on their behalf. It is all the severance pay you might have paid to an employee that have left you. It is all of the group health care costs that you have, including insurance. And it is all the retirement benefits, the 401k payments, any state and local taxes that you're paying, and by the way, anything you have paid to 1099 employees. So you're going to take that gross amount of all those numbers, and then you're going to reduce it by any employee's prorated salary who makes more than $100,000. We'll show you how you get to that reduction in just a moment. You're going to reduce it by the FICA, the payroll taxes, federal payroll taxes that are associated with that payroll. And if you happen to have employees who have a residence outside of the USA or its territories, they work in a U.S. territory, that's perfectly okay. But if they are residents of a Canadian employee, all right, who lived in and was a resident in Canada, he would not be eligible. And finally, it's going to be reduced by, all right, any amounts that we pay relative to sick leave or family leave that is covered by the Families First Coronavirus Response Act. Tim's going to talk about that in just a little while. But under that act, all right, okay, there is special consideration, additional family and sick leave being granted to individuals, various categories, caused by the coronavirus. And under the provisions of that law, there is means for you to get fully and completely reimbursed for any costs that it has to you under Section 701 or 703 of that bill. So Tim will take that up, but of course, it's not going to be 2 times. You're not going to get compensated for it twice under this and under 701 or 703 of the Families First Act. So I'm going to use an example. I believe that examples, all right, really make it easier for us to understand the gobbledygook that's contained by these generic definitions of things. I'm going to take you through a 25-person company that has 20 persons that work for it, none of whom makes more than $100,000, and their average compensation is $62,500. In this particular company, 4 persons that work there have an average pay of $150,000. They may be well-paid commission salespersons, for example. 4 persons make over 100 and average 150. And the owner of this company, because he's been in tag a while and makes a lot of money, has a personal salary of $300,000 that goes through W-2. Is not, all right, a distribution under his company. All of that is included in the payroll. 20 employees, salaries, wages, and commissions, at $62,500 is equal to $1,250,000. We take it and we annualize this. And by the way, the payroll that we are looking for is going to be the payroll that you incurred for the 12 months just before your loan is approved. For most of us, hopefully that means the period from April 1st to March 31st. That's certainly the payroll period that your 7A lender is going to be looking at to determine your eligibility. April 1st of 2019 through today, March 31st of 2020. In that period of time, I paid those 20 employees $1,250,000. I paid the 4 employees who earned $150,000 each $600,000. And as an owner, all right, I took a salary of $300,000 through W-2. My group health, payroll taxes, and other taxes added up to $350,000 during that period. And my retirement benefits, like a 401k, this one's computed at 3%. That portion of the 401k that you pay for, not that your employees put in, was $75,000. Severance pay in my company and 1099 payments to third parties that work for me under a 1099 scenario added up to $95,000. So when I took all of these numbers, I came out with everything that is in my included payroll. It adds up to $2,650,000. But when that's happened, I have to reduce it by certain amounts. I start with my total included payroll for that period again, April 1st through March 31st, just ended, $2,680,000. I can get the vast majority of this information from my payroll records. What do I exclude now? Well, I had 4 employees that made $150,000 each, $50,000 more than $100,000. I have to take that $50,000, the amount above $100,000, times those 4 employees, and I'm going to reduce my included payroll by that amount. I, all right, had a salary of $300,000. Only $100,000 of my salary is allowed to be included in this computation, so I need to reduce that total included payroll by the $200,000 excess paid to me. My payroll taxes for all of this payroll was $180,000, and I need to reduce from my payroll the payroll taxes that I have paid to support this. And I had one individual who was a Canadian resident, happened to make $60,000 for the year, and I need to exclude his $60,000 worth of non-U.S. residence wages. It is residency where they reside, not citizenship, that counts. The total excluded amount, $640,000. That leaves me with a net payroll of $240,000. Now, to figure out my loan eligibility, I've got to get to this annual net payroll for the 12-month period commencing April 1st through March 31st. Pretty easy to do. And then I need to divide it by 12. Happens to be, in my example, $170,000 a month. My eligibility, regardless of any actual damages that I have incurred, unlike almost any loan program we've ever seen, do not need to prove the harm, need to be able to aver to the expectancy of harm, and my eligibility will be 2.5 times the average monthly payroll of my net. In my case, that's $425,000 that I am eligible to borrow, 10-year likely term, at a maximum term, 4% interest. I'm going to actually need to know my net payroll per week also, because that's going to determine how much of what I borrow is forgiven. If I take that same $2,040,000 and I divide it by 52, I see that my average weekly payroll is $39,231. Now, the first thing that is so exceptional about this loan is eligibility limited to a single criteria. Are you a small business under 500 employees in business on Feb 15? Second thing, right? How do you measure how much you're going to be able to borrow? It's plain and simple. What is my net payroll? My included payroll less exclusions times 2.5, the average for my last 12 months. Very easy to quantify how much I can borrow. And then how much will be forgiven. This is the second most extraordinary thing. The objective of this whole program is to get you to keep people being paid. And they do that by agreeing to forgive a huge amount of the payroll you might borrow, or the amount that you might borrow under the Paycheck Protection Plan. Here's how the forgiveness portion, something more extraordinary than anything I have seen in my business career, is going to work. You will be eligible for loan forgiveness for the amount that you spend starting on for the 8 weeks, starting on the day your loan is approved, the origination date of the loan, for the following: all of your payroll cost during those 8 weeks, all of your rent payments during those 8 weeks, all of your payments for utilities, including power, gas, water, and telephone. Now, those payroll costs are your eligible payroll costs. We've already got to that by figuring out that my eligible cost per week was $39,000 and change. So when I go to compute my forgiveness amount, I'm going to do the following. Caveat, right, of course, the loan forgiveness can't exceed the amount that you borrowed. It's going to be reduced only if you have a reduction in either the number of employees that you have during that 8 weeks and/or, by how much you reduce their salaries. The government is looking for you to continue to employ as many employees as you can and to employ them full-time at their regular wage rate. That's the objective of this bill. That is the philosophy behind this bill. And then to forgive that loan to you. So what I'm going to do is I'm going to take the average number of FTEs. An FTE is a full-time employee. What counts as FTEs are all my employees, full or part-time, but it is the average number of employees that essentially work 40 hours a week for me. So if I have 2 part-time employees working 20 hours a week each, they will count as 1 FTE. I look at the average number of employees that I had last period during this roughly the same time frame, February 15th of last year through June 30th of last year. For me, it was those 25 employees. That's how many FTEs I had during that period of time. And then I look at how many individuals do I still have in my employee in the 8 weeks following the commencement of my loan. So my loan begins on May 1st. I go forward 8 weeks into close to the end of June, and I take the average number of FTEs I have at that time. If it's still 25, there is going to be no reduction in my loan forgiveness for this reason. Because I'm going to take the average number of FTEs as my numerator, 25, and divide it by the average number I had before, 25. On the other hand, if I had let 5 of those individuals go, and I looked at the average number for the 8 weeks beginning May 1st, I'm going to have 20 divided by 25, that's 80%. I get a second way to measure this, all right, okay? At my option, I can change the average number that I'm going to be as my denominator, all right? Okay? From February 15th to June 30th of last year, I can instead change it, all right, to January 1st to February 29th of this year. Real easy decision for you to make which of these 2 options you use. You look at your average number of full-time employees that you had last year, February to June. You compare it to the average number that you had this year, January to February 29th, and you use the lower of the 2 numbers. Because the lower of the 2 numbers will give you a better average computation up here, a better multiple computation. Loan forgiveness is going to be reduced by another amount. Right? That has nothing to do with the number of employees, but the amount that I pay. So for any employee that's out there whose annual salary is $100,000 or less, I don't need to worry about those that are more than $100,000. And if I reduce what I pay them by more than 25%, my loan forgiveness is going to be reduced by that. Let me give you 2 examples. Number 1, all right, okay, I had an average payroll, as you know, of $39,000 and change per week. I go out to my 25 employees and I say, hey, we're all in this together, but, all right, okay, I need to cut you back to 20 hours a week from 40 hours a week. That's a 50% reduction in their pay. What's going to happen is I'm still going to be able to borrow the same amount I borrowed before, but now what will be forgiven is going to be reduced by 25% of their original pay, because if I'm between 25 and 50, that's 25%. That's not going to be counted for forgiveness. So be very cautious, all right, about reducing the pay of anyone during this, especially during this 8-week period, following when your loan is originated, by any amount, all right, that is greater than 25%. I can cut people back, all right, from 40 hours to 32, which is 20% reduction, with no harm, no foul. Payroll to employees that are making more than $100,000, it's possible that they may not be forgiven at all. We're still pending further guidance. We're pretty sure that it is going to be forgiven, but we're not absolutely certain. And by the way, if you do receive one of these emergency grants for $10,000 as a follow-up to your EDIL application, your loan forgiveness will be reduced by that $10,000. It's a grant, right? You already got it for free. You're not going to be able to double up on it here. Great news. By legislation, no matter what amount of your PPE is forgiven, it will not be taxable. A major advantage to us. No taxation on any of the loan forgiveness. So let's go back to my maximum loan and then see how much of it is likely to be forgiven. First week, I get 8 weeks of my qualified payroll forgiven. 8 weeks times the $39,231 of my qualified payroll is $313,848 bucks I borrowed from the government. And after 8 weeks of activity following my loan, we measure, all right, what I actually paid, and the amount that can be forgiven during that period of time is $313,848. If my mortgage or rent payments are $15,000 a month, I can additionally will be forgiven that $30,000 for those 2 months. And if my utilities, my telephone costs, and other gas, internet are $5,000 a month, I will be forgiven that $5,000 times the 2 months, or $10,000 bucks. Total potential forgiveness, I can be forgiven $353,000 of the $425,000 loan that I have taken out. This is an absolutely extraordinary measure being taken on by the federal government. It's rough and dirty 80%, right, or more of my loan will be forgiven. And the balance I will have 10 years to repay, or maximum 10 years to repay. This will be the first time they look at repayment ability, and they will adjust the length of time for me to repay based upon my ability to repay. But the rate will be no greater than 4%, and the first payment will not be for at least 6 months after my loan commenced. Now, if I reduce my FTEs during that period from 25 to 20, it's going to have a big impact, because it is going to reduce, all right, my capacity by 20%. It's only 80% of what I borrowed. My total forgiveness will now only be $353,000. It will now reduce to $280,000. $70,000 of the amount borrowed will not be forgiven if I let 20% of my employees go during the 8 weeks following my approval. There is a hedge factor, and that's because many of us have already furloughed or laid off people. A significant number of you were members of TAG back in 2008, 2009, and 2010. We went through the Great Recession. You'll recall we went on the road with a special How Do I Survive financial class. And the advice that we gave you was this: cut early, cut deep, rehire when you can, but make certain your business survives, because without your business, your employees have no place to go. We strongly recommended that you did not go to your employees and say, hey, we're all in this together. Let's everybody take a 20 or 25 or 30% pay cut as we try to muddle through it. Because that absolutely destroys morale within the company. Instead, we said, keep your best. Get rid of the rest. And survive so your business can thrive and hire them back later. That is not the case today. Back then, we had to bear all the economic burden of keeping those employees employed. And many of us would not have survived had we done so. Today, we have been advising, be prepared to cut rapidly, but let's see what this is all about under these EDIL loans, and under now in particular, the Paycheck Protection Act. If you have already reduced your employment, commencing on, when you look at it as compared to February 15th, all right, how many employees you had, what you were paying in wages for the period ending right on February 15th, and you have cut employees, either now, up to now, or any time within essentially the next 26, 27 days, 30 days after the enactment, which was last Friday, March 27th, and you rehire those employees by June 30th of this year, you will not have your forgiveness of your loan reduced because of the reduction of employees or the reduction in wages. If you make those cuts later, after April 26th, you certainly will be subject to the reductions we were just talking about. A very, very generous provisioning of the loan, which probably suggests this: if you are going to lay anyone off, do it early, but plan to rehire early also. Next question is, where do I go get this loan? Now remember, this is not an SBA loan directly. It is not an EDIL loan. Your prior application for your EDIL loan will not carry over to this loan. You need to go to a private SBA approved lender.
Hey, Dale, can I interrupt for 1 second?
Yeah, please.
Okay, hey guys, we're getting quite a bit of feedback and some background noise, so please, right now, everyone, make sure you are muted because it's kind of hard to hear Dale over the background noise. So everybody on the call, confirm that you're muted, please. This is very important for everyone else to be able to hear it. Thank you. Go ahead, Dale.
Thank you. Thank you, Tim. So which bank should you use? There's basically two choices, all right? All of us have a local banking relationship. It is one of your two choices if that bank is already an approved SBA lender. They probably are, but they may not be. If they are not, they may be applying to become an SBA lender because there's going to be a lot of loans made here. If they are not already approved, I would probably look elsewhere. The second place I may look, right, instead of my local bank, is one of the big high-scale SBA lenders, a major preferred 7A lender of the SBA. We'll be sending out after, all right, this webinar, a list of the 100 largest SBA lenders in the U.S. under the 7A program for 2019. Now, it may be your own bank. If you bank at Wells, Wells is on that list. If you bank at Chase, Chase is on that list. If you bank at Zions or any of the subsidiary of Zions, all right, Cal Bank and Trust here in California, Arizona First National, right, they are on that list. In that case, it's a no-brainer. You go with your local bank, who is also a major preferred lender. Otherwise, you have a choice to make. There's no real bad choice here. Just want to point out to you what the advantages and disadvantages of an application in one of these locations might mean for you. Number one, what are the advantages of getting in front of your local bank? Well, first of all, you have a personal relationship. They also might have a lot of the required documentation that you would need to support, not all by any means, but they may have a lot of the information that you might be required to supply already as a result of your current loan relationships with them. And right, because you have that personal relationship, you well may get first in line treatment. And trust me, first in line is what we're after here more than anything else. Just as the curve of coronavirus goes like this, the curve of applications for these loans is going to go like this. The later you are in getting into the game, the longer it will take to know if you are approved and to get funds for that approval. So we want to be there, okay, as early as we can. And that personal relationship well might let you get first in line within your own bank. Now, there are disadvantages. They may not have the resources to process the significantly expanded quantity of loans that is going to come down here under this program. And if they can't process, you can't fund. What are the advantages of a major 7A preferred lender? Well, first of all, there's no question they will have significantly greater resources, especially at the front end of this curve as opposed to your local bank. They will have much greater expertise in what they need to put together to keep their loans in audit position and all the things that they need to be concerned about, and to get them funded quickly. They will probably have a significantly greater understanding of how the 7A loan might interplay with an EDIL loan and give you another resource for strong information on whether or not you should pursue that second loan also. And the bank itself essentially does get first in line treatment because they've got complete authority, all right, to look at, make, and approve these loans with nobody supervising them whatsoever. Disadvantages: lack of personal contact, and if they're not your bank, without question, you will be starting at square one for documentation. So take those two things into strong consideration. Do recognize that documentation is likely to be quite easy under this. And then, all right, figure out how early you can apply. Reach out to your own bank today. Reach out to a 7A preferred lender if you're going to go that route as quickly as possible. A couple of them may even have online application capacity. We're trying to find that out. In general, all right, we're getting a lot of feedback from the members that were on this webinar here yesterday, all right, even on earlier today, that have reached out to their banks about getting an application for an SBA 7A loan under the Paycheck Protection Program. And so far we're hearing we're not quite ready yet. We think we will be ready Friday, April 3rd. Just saw a new document released right by the SBA itself that says, click here to find your 7A application. You click there is no such application. We're going to stay on top of this. You need to stay on top of it with your own bank. Call them up today, all right, March 31st, and say, I'm coming in for my 7A. Please put me on your list. The moment you have forms, please call me, email me, text me. Let me know because I want to get my application in. As early as you can. They are processed generally in sequence of receipt. But they're also processed in sequence of receipt with important documents that are critical to do it. Certain documents are going to be absolutely required to pursue under this loan, and you can have every one of these ready to process even before the bank is ready to accept your application. You can have them there the moment that he says, I need, you say you've got. And what are those documents that we absolutely know? Well, because the way that eligibility is computed here, here's what we know you're going to need. You're going to need your 2019 IRS quarterly 940, 941, or 944 payroll tax reports. Depending upon the nature of your entity, you are doing one of these three types of reports that tells the IRS every quarter information about your payroll. From your payroll reporting service, whether it's ADP, Paycheck, whomever it is, or your internal, if you are doing your payrolls internally, you're going to need your payroll reports for the last 12 months. I would do from April 1st through March 31st. For example, for us, that means we just made our payrolls, all right, our pay dates are on the 5th and the 20th of the month. So I would go from, all right, my first payroll in April of last year, April 5th, through the last payroll I made in March 20th. That's all 12 months of my periods. And it's going to show the gross wages that I paid for every one of my employees, including officers that were paid under W-2. It's going to show the paid time off for each one of those employees, the vacation pay for each, the family medical leave, if any, arrived for each of them, and the state and local taxes that were assessed on that employee's compensation. All the critical factors that are necessary to determine your eligibility. Going to be the single most important documents that you get to your lender, and you want to have them there instantly because then they can begin your processing. Even before they've dotted their other I's, even before they've crossed their other T's, they can figure out that you are eligible for X. Let's set that point aside for your company. I would upload every one of those documents that I possibly can if they give you a means of uploading them directly into your system. But simultaneously, I would either FedEx or hand deliver them as additional backup to my lender. I want to give them two places where they can look, because trust me, as this volume incurs, there's going to be a lot of stuff. Otherwise, it's lost. If you get it there early, if you get it there in two different forms, if you get it there before, okay, there are 12,000 other pieces of mail arriving on the same day, you're going to get funded early and easily. You're going to need the 1099s. This you can follow just a little bit later, all right? You're going to need the 1099s for all your independent contractors. You should be able to put them in the same bundle. We were supposed to have done those no later than 60 days or so ago. And, all right, all you need is a documentation that shows all of the health insurance premiums that were paid by your company under a group health plan for both employees and owners. There may be some areas of health coverage that may or may not be eligible under this. I would include them. If you are paying, for example, premiums for long-term care of some sort, for example, for some of or all of your employees. And you should have totally available to you the sum of all the retirement pay funding, all right, that you've made for your employees, all right, and that should actually be visible to you, right, at whatever time you do your 401k computations and plans. So this is for all employees and owners, both of these, for insurance and for, right, the 401ks or your simple IRAs, or if you've got a SEP IRA for those. Have that documentation ready so that the moment you fill out your application, you can all coincidentally upload it. So at the moment you fill out your application, you can coincidentally either put it in the Fed or drive it over and drop it on the doorstep of your lender. Here's what's also going to be an advantage. Again, unless you are 60 or 70 employees or more, you will not have a payroll where 2.5 times your qualified payroll is greater than $1 million. That's going to put you in this time around for an express loan. It's another remarkable provision of the loan. They've increased the amount of SBA express loans from $350,000 to $1 million, almost tripled it. All your preferred lenders and your local lender means they can get this loan through the SBA system in a dramatically quicker fashion than if the loan was greater. So it promises rapid funding of all of these Paycheck Protection Program loans, a critical provision of the loan. Second thing, many times what slowed down SBA funding is that under all of the traditional SBA financing, in particular, all right, 7A financing, you had to establish, all right, that you could not get the loan without exhausting your personal resources or without exhausting, all right, your lines of credit, your existing lines of credit. Legislatively removed, no requirement for you to use any personal resources whatsoever. You will still be eligible for the full amount of this loan. Major, major, major thing that I've never seen in the history of the SBA. There is no requirement whatsoever to figure out if you've got a chance at all to repay the loan. You do not have to demonstrate repayment ability. You have always had to demonstrate repayment ability under any form of SBA guaranteed loan, whether direct, 7A, or 504. Always legislatively removed, not a criteria. No need to consider. It's going to do two things, all right? It not only, all right, okay, gets that barrier out of the way, it improves and speeds processing dramatically because a lot of the gymnastics that are done internally at SBA are done with these issues. It's a long time ago, but I'm very, very familiar with them. 40 years ago, all right, a little more than 40 years ago, I ran the SBA disaster program for all of the Western United States, Hawaii, Guam, and the Marianas. And I know the struggles that they have establishing this and the next item we're going to talk about, and that is not just personal guarantees. By the way, those are also out of the ballpark, legislatively removed. You don't need to personally guarantee these loans. But also, there's no requirement for collateral, which has always been historically the second hurdle. Yeah, the collateral didn't have to be great, but what collateral you had to give, and that meant that funding was always hung up while the lender, 7A or disaster, went about perfecting his collateral position. Challenging things to do, out the door legislatively, continues to make this, again, the most extraordinary loan program I have ever witnessed. There is a lot of noise, right, that the SBA is going to file a blanket UCC1. No big deal. They'll subordinate if you ever need it to be subordinated in the future. And, right, it takes about 30 seconds to do so. That's this loan in a heartbeat, right? Tim's going to take us in just a moment right through the Families First Coronavirus Relief Act. But I would like at this point in time, right, to first, okay, open this up to Q&A about, right, this loan. You may process them in two ways. I'd love to hear from you. I'd love to hear your voice. We're talking and gathering here together. We'll answer as many of these we can during a reasonable period of time following this. Right? I know we've already taken the full hour that we budgeted for this. I have more time if the bridge is still open, Tim. I don't think we have any need to close it any further. As long as anybody wants to stay on the line for the next hour or so, all right, answering and asking questions. You may also put them into the chat. Anything that we're unable to answer here, we will get back to you within the next day or so. Please give us a little bit of time to assimilate your question, make certain we've got an accurate, viable, and most importantly, actionable, all right, answer for you to be able to proceed with them. Okay?
All right.
Greg, do you have a question there? Greg Swears?
Yes. Do I have to, when you're doing the calculation, do we apply the payroll taxes on the first 100,000 for those over, or the entire payroll tax of the 2.6 million when you were doing those exemptions?
You are going to, first of all, okay, include 100% of the payroll taxes and 100% of the compensation, right, in your gross calculation of your maximum loan amount. When you go to reduce that amount, you will reduce it only by the direct compensation in excess of $100,000. You will also reduce it by 100% of all the payroll taxes that we included above when you put it in and you take it back out, 100% of payroll taxes. I'm not certain why they ask us to do it that way, but that's what they're asking, so I would suggest we do it. Does that make sense?
I think so.
Well, let me rephrase it, Greg, okay? One, as you compute your maximum eligibility, you include payroll taxes and all the compensation over $1,000.
Okay.
As you compute the amount by which your maximum eligibility is reduced, you first of all reduce it by 100% of all of the payroll taxes that you included up above. And then you reduce it by the excess over $100,000 that you paid to employees that made more than 100.
Okay, so you're putting in all the payroll tax, and then you're taking it all back out. There's really no net change there.
There appears to be no net change there, Greg. I'm looking for, that's how they say to do it, so that's how I'm going to do it right now.
Got it. Okay, thanks.
Next question.
Hey, Dale, Javed had a question. Javed, I can read it, or you can jump on. I think you're muted. Javed?
You're muted at the moment, Javed.
You're muted on the app. So Dave had a question on
Hey, Tim, can you hear me now, or Dale?
Yes.
Yes, sir.
I can.
Yeah, so my question is just regarding the 1099 employees. Not employees, they are actually subcontractors. So I heard from another source that 1099, if you put those in, it can be a problematic, meaning that because they're not considered as employees.
Well, the indications we had, Javed, is that 1099 employees will absolutely be included. On the other hand, all right, subcontractors, okay, companies that you pay
Mm-hmm.
that are not under 1099 will absolutely not be included. And the reason's pretty simple, okay? Most 1099 employees are going to be, all right, not eligible for compensation from any other source unless you continue, unless you are able to pay them as a 1099 going forward. You don't have to. It's got nothing to do with the reduction. But your subcontractors, all right, okay, they too are out here seeking, right, likely to be seeking SBA assistance and 7A loans, payroll protection loans for their employees. So the government's not going to let a double dip into the payroll paid by subcontractors. Same things, we had a question earlier today, well, what about payments, all right, to companies such as Continuum for my help desk activity? Not part of the equation.
Okay. So vendors are not included.
Vendors are not included. 1099 is different. If you actually cut a 1099, every piece of information we are getting says you may include it in your gross loan proceeds without impact on at all, all right, any reductions associated with employees.
Got it. Thanks.
Okay. Hey, Dale, Chris Chandler chimed in on chat to ask if he could ask a question. So Chris, are you available? You can unmute.
Thank you, Chris. How are you doing?
Oh, Chris, we can't hear you.
Is that better?
Yeah.
All right. So when, we obviously talked the other day, the forms that we filled out and sent in, are those pretty much null and void that we did the other day? Or are we talking about new forms with the bank? Actually, while we were sitting here, our bank guy just actually sent over saying he was ready for us to come in and they were approved lender.
Perfect.
Are those forms still in play or are these something totally different?
Yeah, that's what I was trying to say earlier. Let me make it absolutely clear. Any forms that you have submitted to the SBA for your EIDL loan are not germane here. They are not germane here. We wanted to be in line with the SBA. We had no idea how much of this was going to be direct or how much of it might, flow through to the 7A lenders. We did not know, whether or not they were going to be able to transform those Form 5s, to a 7A application. They have elected not to. So now the point is, get on over. If your banker just called you and said we're ready, Chris, I'd be there this afternoon.
All right, so that was my point. We're going to just go straight to the bank and basically there's no form that we're filling out. It's taking this information to the banks themselves.
They will have
them deal with everything.
They will have a new SBA 7A loan application, 7A disaster loan application. To date, no one else that we have spoken to has seen that application, albeit we have one member that was in the middle of a different type of SBA loan with a 7A lender who took all of her information and is processing it, but I don't believe she's seen a formal application specifically associated for these loans. If you get one this afternoon, please forward it. That's what I was saying earlier. About 2 hours ago, we got an official announcement from the SBA saying, hey, here's what you need to do. And by the way, click here. Here's the application form. And if you click there, there was no application form. So neither Tim nor I nor anybody else that we have talked to, and we've talked to probably 150 companies in the last few days, has seen an application format to date. If you get one, please forward it.
All right, thank you. Appreciate it.
Any other questions?
There's a few more posted.
Questions this morning. How can it possibly be down to none here?
I've got a question.
About 401k.
Go ahead.
Go ahead, Maggie, please. Maggie, Kristen, please.
Yeah, the 401k, Dale, is it just the employer portion that will be accounted for, or both the employee and the employer?
It will be just the employer portion. So whatever amount, you have paid in the last 12 months on behalf of your employees into their 401k programs will become part of the amount you can borrow under this program, but not the amounts that they have put in themselves.
that includes the ownership as well, right?
Absolutely. All of these provisions include all activity for ownership under W-2, under health insurance programs, and a right under 401k or other retirement programs, even if the owners have a differing retirement than your employees do for whatever reason.
Okay, thank you.
Next question. Sure.
Richard Valle, you had a question, I think?
Yeah, I have a question about adding or hiring new employees during that 8-week period, as well as we have an employee that's scheduled to get a raise during that time period as well.
Okay, first of all right, what you do, Richard, in terms of new hiring or the like could be helpful. You won't get any extra benefit if you have more employees during that 8-week period than you had during either one of those two measuring periods. And remember, those two measuring periods, you want it to be the lower number. It's either the number of full-time employees that you had approximately a year ago between February and June of last year, and the average number of full-time employees, or the average number of full-time employees you had between January 1st and February 29th of this year. If you add employees, if you have more than, you had it either one of those times, you get no bonus points for it, but you absolutely would not be subject to any reduction in the amount that you will have in loan forgiveness because you have reduced staff. As to raises, same thing, they're going to look at the aggregate compensation, but more importantly, they're really asking, we believe, this question: is there any employee who makes less than $100,000 whose wages you reduced by 25% or more during this period? To the extent that you reduce them by more than 25% for that 8 weeks, just as payroll during that 8 weeks, we are going to reduce the amount of the loan that we're going to forgive for you. Any individual computations that you want us to do about this 8-week period of time, we're delighted to do so. It's premature to start doing them now until we get closer to the point, where you at least have documents submitted and are getting loan approval. They can be done pretty quickly and pretty straightforward to you at that moment.
Thank you.
Other questions?
I have a question, Dale.
Javed, who has asked, that I'm seeing here. Javed, you can repeat this out loud.
Yeah, just Dale, if you can hear me. Just asking, we are in New Jersey and New York City, close vicinity, which is an epicenter. So is there any extra provisions included in the loan?
Well, not in the CARES Act loan, not in the payroll protection program. Those are absolutely equal no matter where you are, any place in the 50 United States, any of its territories. What is and may be different is that there is the possibility, if you are in that epicenter and are suffering, significantly greater declination of business and more direct business harm, that you may be able to piggyback an EIDL loan for amounts above and beyond what is available under 7A.
Okay.
So just be cautious. Absolutely proceed with 7A first and foremost, and then be gathering the documentation, of what happens. It is those such as Java, that I am using as standard of what is going to happen to us all. We now have epicenters in New York, in New Jersey, in Connecticut, Northern California, in some cities. Guess what, guys? There's going to be an epicenter no matter where you live.
Yep. Thanks, Dale.
Dale, hi,
I thought
Rick.
I saw.
I've got a question for you.
Rich, how are you today, Rick?
I'm doing well. I hope everybody else is doing okay and is safe. Are there any provisions or any gotchas that you're aware for those of us who own our own buildings and pay ourselves rent under this program?
Right now, I don't believe so, We are completely of the opinion that any rent, that you pay yourself, say yourself individually, all right, that your company pays is going to be fully, all right, appropriate for usage under this loan and capable of being forgiven. And we believe that if instead your business owned the building, all right, itself and had a mortgage, that the mortgage payments that the company made directly will be fully reimbursable, eligible under this loan. We do not see any gotchas. If we hear any, trust me, we'll be out there quickly to tell you.
One clarification on that, Dale. I believe it's the, I don't think it's the full mortgage payment. I believe it's the mortgage interest portion of the payment.
Yeah, I believe that needs clarification. I've seen both in 4 different samplings. I've seen 2 that have said mortgage payment and 2 that have said mortgage interest.
Gotcha. Hey, Greg asked a question that's come up on the 2 prior calls to this as well, which is what if owners are taking distributions rather than W-2 payroll?
Yes, an important thing that we have not addressed. I meant to have a slide on it. Distributions aren't going to count, guys. Right? They're not going to count. And this can be significant. All right, I will tell you, all right, that there are many companies that have listened to tax advice in the last 2 years that are pass-through entities, all right, that are either LLCs or sub-S's and like. And the advice of our tax attorneys has been, you know, get your salary down and take more in distributions, because 20% of the amount that you take in distributions can be excluded under the last tax act, one that went through in October of 17. So a lot of us are in that situation. A lot of people are in the situation where, okay, there will not be a loan amount available to them that would be equal to even perhaps what they were taking in salary a couple of years ago. But there's no question in my mind that distributions will not be included in the provision.
And remember that it would be only in salary that would be up to 100,000 anyway. So if you take a salary and then take additional distributions, the amount above 100,000 wouldn't count anyway. What I see is typically a owner taking 50 to 100,000 a lot of times and then taking the rest in distributions. If there's anybody who takes no salary at all, they would be probably affected, as they wouldn't be able to get their own salary included in the loan. But again, you know, in the grand picture of things, you know, still go through the process, and you know, you'd still want to go through it. And it's 2 months of your own salary. You know, move forward.
Yeah, and Tim's point on 100,000 is absolutely critical.
Okay.
Thank you.
All right. Let's see if we have any other. Rick Harbor got a question. Rick Valle, you had one more question, you said. Did you want to chime in with one more? Richard Valle? Okay.
I believe Tracy's also trying to get a question in.
Hey, I've got one. Sorry. I just had a quick one about about the balance left over. Let's say we don't use everything that was given us. Can we return it? I thought I read something about that.
The answer is absolutely. Let's just talk about the amounts that are not forgiven. There are some companies that have a high bias to not having any debt. So I go out, example I just used, I go out and borrow $425,000. That's what I'm eligible for. I comply completely, all right, with everything that I'm supposed to do. I do not reduce my head count. I do not reduce any salaries. And I find out that I'm going to have $383,000 of that loan forgiven. 2 things can happen thereafter. Number 1, they will give me the period that I'm going to amortize the loan over. It will be no more than 10 years, maybe less. Or if I had the desire to be debt-free, I simply repay the balance right from the proceeds that, let's say, I still haven't expended. Or I repay it at over whatever time I want to, because there's absolutely no prepayment penalties of any sort. So hopefully that clarifies it, Rich. The fact is, this is a great situation for us. You have your cake and you get to either eat it or return it. Tracy, would you please chime in with what you were looking for?
Yeah, thank you. I just wanted to verify, you might have already answered this earlier, but what happens if I already attached those forms, like the form 019 and the other form, what if I already attach that in an email and send it to the SBA, like a couple days ago when you guys were saying that we need to get those forms in? Will that affect me trying to get this 7A loan now, or do I just not proceed and do anything else and I'll be okay?
You should be okay. We will give you guidance. We're certain you're okay right now. Immediately
Okay.
go after the 7A loan. It will be new paperwork. Right? We'll give guidance to you as we come to understand your particular situation a little bit better, right? As to whether or not you should formally withdraw the other application. As you get loan funding with the 7A, right, you may want to consider it. But you're also going to be looking at the amount of damage that is being occasioned to you in the real life marketplace. If you are in New Jersey, as my friend Javed is, okay, you well may be keeping that application open, right? And
Okay.
I don't think we're going to have any harm, any foul with simply having the applications there, as long as you do not fund any portion other than the emergency portion of the EIDL loan. That 10,000 is no problem funding.
Okay. Thank you.
Yeah, and Tracy, one thing to chime in on that, for 4 out of the last 5 days last week, the guidance that I had from the SBA was, hey, we're dramatically reducing requirements and paperwork to get the EIDL out. At that point in time, they said we may see something else in the form of legislation later in the week. But even this is a representative from the SBA that was on a conference call that I participated in, and said, we have no idea what's going to be in it. We have no idea how it's going to be handled. And we have no idea whether it will be in conjunction with the SBA or some other process, essentially. So, I'm paraphrasing them, but basically we figured last Thursday night and Friday that if you had an application that you were working to get in, not the supporting documents so much, but at least the application to get your place in line, that would be the prudent thing to do. Over the weekend, it's kind of become more clear that the process that the application would not just be transferred over to a local bank. So there's no transfer of that application, but I think it was prudent based on what we knew last week when this was just barely coming out to make sure that our folks got their, placed in the queue, so to speak, because we didn't know that whether it would help or hurt. So better to have it better than not. So just anyway,
Right.
that's explanation, because I know you spent a lot of work and you sat on the phone for quite a while with the SBA waiting for someone to pick up. So I don't want you to feel like it's wasted, but it was good. It was
No,
good work.
that's okay. I just make sure I can withdraw it if I have to, or if I don't even have to do anything else at all, just don't even just don't even move forward with it. I just was kind of trying to verify that.
Correct. Yeah, just let it lie for now. Proceed with your local bank or a national bank, depending on what you want to go with, an SBA lender, and follow their guidance.
Okay, thank you.
Tim, I think you should begin presenting the family leave. We've been an hour and 20 minutes already on this call.
So this will go quick, guys. What I'll do is we've had a lot of questions on this as well. So let's just, make sure everyone's aware of what needs to happen. So the other law that was passed back in, I guess, mid-March, I want to say, is this Families First Coronavirus Relief Act. This is basically their emergency declaration to ensure that people that get sick with this or have some other circumstances can have time off. Obviously, that's a good thing to do, since people who are sick that are also dependent on income coming to work is probably not the best thing if they have to choose between their staying home and coming to work and not getting paid. So this law covers everybody, every business under 500 employees. There is no exemption for employees under 50, like we see with some other things that happen. There is a very small exemption that probably won't apply to most of us that I'll mention later. So it basically says that for every employee employed for at least 30 days is going to have the opportunity to get paid sick leave for up to 2 weeks of paid sick leave. And then also there's an opportunity to gather up or to obtain an additional up to 10 weeks of family and medical leave. So basically what their benefits are currently under FMLA. So what's going to happen is they're going to have a kind of a required reason for this. And oh, by the way, as we go through this, the first question I get, wait a minute, is the employer required to pay for all this? Later on, you know, there's 3 or 4 slides here, but we do get reimbursed for 100% of what we do here. It's mandated by law, so you got to do it, but you should get made whole dollar for dollar. So if you have an employee who's subject to a federal, state, or local quarantine, that is a direct quarantine order to stay at home, not just the shelter in place we're seeing, but something that's, you know, essentially mandated by law or by directive. If you have an employee who's being treated for COVID-19, or somebody that has been advised by a healthcare professional, which is happening in a lot of cases where they say, hey, you may have it, we can't test you, or maybe they're doing it over the phone, saying you have enough of symptoms that the doctor or the nurse practitioner says you should self-quarantine. So if they're instructed to stay home, essentially, then they qualify for this additional time off. Third reason is the employee is experiencing symptoms and they tell you that they're sick, essentially, and that they're trying to get a diagnosis. So a lot of times, you know, folks are experiencing symptoms and they need to get a test, or they need to get a doctor to tell them if they have it or not. So if they're under that scenario, they don't even have to have proof from a doctor that they actually have it. If they're just either diagnosed self-quarantining because they probably have it, or if they're worried that they might have it, they can take this time off. 4 and 5 are really for folks that are ancillary to this, where you have an employee that has to care for someone who is subject to the number 1 and number 2 above. So someone is quarantined, someone has potentially, been told to self-isolate, and you have to, and your employee is the one that has to take care of them. And then the last one is related to probably all of us, including Carver, who just seemed like his daughter was walking around behind him a minute ago. If the employee is forced to care for their own son or daughter because their school or childcare has been closed, and they have no other options, they can't work from home, they have to stay home to take care of a child, then they are also covered as well. So first thing we'll address is just the sick leave. Employers, if anybody is under those first 2 or 3 items below where they're personally affected with or suspect that they have it, you give them 2 weeks off at full pay. It is capped. It should be more than enough to cover most employees, capped at $511 per day, or about $5,000 for the 2-week period. Okay, so they get 2 weeks of paid sick leave under this program. If they are the other ones where they are caring for someone affected or caring for a child that they have no health care or no child care for, they can still take the 2 weeks off. It's still considered sick leave. However, they are only going to receive 2/3 of their pay rate, and it's capped at $200 per day or $2,000 total for the 2 weeks. It goes bearing to note, they were very specific in this, that if you have hours or reduced operations that you're cutting, the business is cutting, you cannot supplement their pay by having them apply for this. So if it's if the hours have gone down, or if you're essentially furloughed anybody, obviously you cannot, they say you cannot put that forth as, oh, well, you take sick leave for 2 weeks from the government. So for employees, this is getting over to the family leave now. This is very narrow and specific. It only applies to one of those 5 reasons. If someone has a child that they have no other options for healthcare, and obviously everything's closed, that person, if they have to stay home, can take it up to an additional 10 weeks in addition to the first 2 that they got at 2/3 pay, okay? But it is only for folks who are in that situation where childcare has been taken from them. So it's in addition to that initial 2 weeks that's covered technically as sick leave. And another important thing here, employers may not require the employee to exhaust their PTO or any other sick leave that you're required to give them. You basically have to, they want you to use this first before you have the company or have the employee empty their PTO bank. Also notice that the effective date is April 1st. If you have somebody that was sick last week or sick this week, you don't get reimbursement unless It's only for time off subsequent to April 1st. That's what it says. So anything up to April 1st would be covered under your normal PTO policy. Anything subsequent to April 1st should and will fall under this federal law. So if you have less than 50 employees, I wanted to put this in here, you may be exempt from that extended family leave, which is only for childcare. But it's only exempt if you have less than 50 employees and you can demonstrate to the government that letting that person go for 10 weeks would jeopardize the business as a going concern. Probably doesn't apply to most of us on this call or any of us. Also, the Department of Labor hasn't really been terribly specific about how do you demonstrate that they would essentially cause you to go out of business if they were gone. So if you think this falls, you have this situation, you might want to start documenting now as to why you think you fall under that and make sure that you comply with it. So last thing, and then I'll get to the reimbursement, is notice. You got to let your employees know that they have this. This should be posted in your workplace if you're still going to work, and also if not, you can email it or actually direct mail it to your employee. You want to make sure, because it is written into the bill, that you get employees get notified that they have these new rights. So make sure you email this to everybody. Most folks have, a lot of people from working from home. So there's a PDF available on the Department of Labor website, which will give you directions to, or we'll email it out to you. And probably best just to email it to everybody. The reimbursement's pretty simple. It says basically that employers shall be reimbursed 100% for any of this paid leave that anybody qualifies for. It's the payroll cost and the health insurance. So I believe you can actually get reimbursed for the proportional amount of payroll of insurance premiums. And it also says you won't face any payroll taxes for this time that you give on the folks that are being that are taken off. How does it get reimbursed? It gets reimbursed through an immediate tax credit on your quarterly tax returns. So the 940, the 941, or 944, whatever your payroll provider files on your behalf every quarter for payroll taxes, this will be a direct offset against those amounts. Most cases, you probably wouldn't be entitled to a refund if it was in excess of what you owed, but in that case, they said they would be very prompt with, issuing refunds as well. For most of us, this would just be basically, okay, instead of owing X for employer portion of payroll taxes, it's going to be X less whatever this amount was. So what do you need to do right now? Just familiarize yourself with what this means. Make sure that your accounting or HR, whoever handles this kind of thing, just keep track of what you pay people if they fall under this, if they get affected by COVID-19, and then also get with your payroll company to say, hey, we have a situation with an employee, we're going to need to file for this tax credit. What information do you need? If you outsource payroll, they should be all over this. They should be able to tell you precisely how to get it, and they should be able to file for it on your behalf. So that is that. Any questions on that piece of it? On the HR stuff?
Tim, I posted in chat for employees who can work at home, but are also having to work from home because they are taking care of kids, have to do school with them, and whatnot, and so they're only working partial days where they normally would work a full day or some amount of time.
Mm-hmm.
So they just have to track that and report that, and that's we still pay them the full amount, but we just basically report their reduction in work, and that's the amount that's reimbursed.
It doesn't address partial non-working from what I've read, but I would tell you you could probably look into that a little bit further. If someone's unable to come to work because they have that situation, then they qualify. Now, if they're also working from home somewhat, I don't know how they would handle that, but that'd be a good question to ask kind of an HR professional who might be more versed in it. I don't think that they've spelled out how that's going to work. At least nothing I've read has taken into consideration partial. But you know, if they have that situation, you know, you could file for it because it certainly qualifies for 2/3 pay for up to 10 weeks in addition to the first 2. So I guess a good answer for that is great question. Not sure how it would work, but you could certainly, it seems like something that would certainly fall under it if they're not working because of this healthcare situation.
Yeah, I just can't imagine that's not a common scenario.
Yeah. Yep. Any other questions? Oh, Dale, are you talking? I can't hear you. Are you muted?
Yeah, for once, everybody should be happy. I was muted. If there are other questions, all right, first of all, I'd really like to thank you for all being here. I don't think we ever see times that the strength of this organization and that the amount of capacity that we can transfer one to the other is demonstrated more than when times get tough. So many of you have been submitting to us, all right, tidbits of information, releases from one or another bank, releases from one or another of your CPAs that is helping us coordinate, gather, and redisseminate, right, the information that is going to let us get through this thing as effectively as we possibly can. So I love it for being in TAG. Thank you for being here. And I wish you all safety more than anything else, for your well-being, for your families, and for all those that you love. Have a great additional days. We will respond to as many questions that we haven't in some form. Tim's putting together an FAQ that I think is just a great idea. It'll be disseminated to you. Once we get it up, it'll also be posted on our website. So let's stay in touch. Any of you that do begin this process with a 7A lender, please send us what you're getting. Chris and Tracy, for example, you seem to be at a point where you may be able to get that a little bit earlier than most. That would be fantastic. Help us, help you. Thank you again, everyone.
Yeah, I was just saying, I think I can speak for everyone. The work that you and Tim and the rest of your staff have done is greatly appreciated. This has been probably unprecedented in the amount of information. It's been staggering to process, and you guys have done a fantastic job in conveying it down to us. So I'm very thankful. I'm sure everyone else is too.
Yeah, thank you. Thank you, Dale, and thank you, Tim.
Thank you, guys.